Welcome to this explainer. Okay, we've got a lot of fascinating ground to cover, so let's just dive right in. Today, we're going to unpack the raw, mechanical history of the 1990s dot-com bubble. We're going to get under the hood and really examine the anatomy of market euphoria so we can understand exactly how and why things spiral so wildly out of control, and honestly, what it teaches us about human behavior. So let's kick things off in the absolute absurdity of January 2000. $2 million. That is the exact amount spent on a single 30-second Super Bowl advertisement. And the company that footed the bill? Pets.com. Now keep in mind, this company had only been in business for 9 months. It had never turned a profit, and frankly, it had absolutely no clear path to ever turning one. It literally sold pet food online and shipped it to your door, which, back in 1999, felt like absolute science fiction. But here's the real kicker. By November of that exact same year, Pets.com was completely gone, liquidated. Even their famous little sock puppet mascot got auctioned off. But the truly fascinating part is that the $2 million ad wasn't the reason they failed. Actually, it was the entire reason they existed in the first place. Back then, spending money you simply did not have to acquire customers you couldn't keep for a product you couldn't profitably deliver, well, that wasn't a red flag at all. No, that was considered a legitimate growth strategy. It was the widely accepted template for success. Section 1. The Infinite Growth Illusion. Okay, to really wrap our heads around how this happened, we got to jump back to 1995. The internet wasn't just some new product, it felt like humanity had unlocked an entirely new dimension. And the intoxicating thesis of the time was that the web would eventually connect absolutely everyone. Every buyer to every seller, every business to every customer on the planet. And the underlying logic? The first company to capture that connection was going to win everything. Period. Whoever came in second would be worth exactly zero. And this intense pressure birthed a really aggressive set of rules. Move fast, spend everything, acquire users, and hey, worry about profit later. Now, this simple, incredibly seductive logic wasn't just cooked up by amateurs in a garage somewhere. No, it was actively endorsed by serious venture capitalists, top-tier investment bankers, and even publications like the Harvard Business Review. And let's be real, when the smartest people in the room are validating your actions, it makes reckless behavior feel absolutely correct. And you know what? For a brief, glittering moment in time, it really did appear to be correct. 400%. Just take a second and let that staggering figure sink in. That is the unprecedented rise of the NASDAQ Composite Index over just a 5-year period from 1995 to 2000. Companies that had literally never earned a single dollar of actual profit were suddenly being valued in the billions. The only metric anyone cared about was eyeballs, not earnings. Traditional revenue, that was just written off as some boring, outdated concept. The euphoria ran so deep that a company called theglobe.com saw its stock skyrocket an astounding 606% on its very first day of trading in November 1998. It was one of the largest single-day gains in the history of the New York Stock Exchange. Did theglobe.com have a sustainable business model? Absolutely not. But the crazy part is nobody even bothered to ask. Section 2. The Crash and Cost.
But, as we all know, gravity eventually always wins. Fast-forwarding to a pivotal turning point in March 2000, the market's collective spell was just abruptly broken. And it started with something that seemed kind of disconnected. A U.S. federal judge ruled that Microsoft was a monopoly, which suddenly threatened to break up the most powerful tech company in the world. Now, this legal ruling caused a sharp one-day drop in tech stocks. But that single day of falling? That was enough. It acted like a bucket of ice water. Investors suddenly opened their eyes, stopped looking at all the hype, and finally saw the completely impossible financial projections and the frankly terrifying cash burn rates. And so, they started to sell.
And once that started, the pure physics of a crash took over. When enough people sell all at once, the price falls, which of course triggers even more panic selling, resulting in a completely devastating 78% plunge. The NASDAQ plummeted from its absolute peak of 5,048 in March 2000 all the way down to a staggering 1,114 by October 2002.
Which brings us to the sheer crushing weight of this next figure, $5 trillion. Gone. Now, it's really vital to understand that this massive amount of market value wasn't simply transferred into someone else's bank account. It was erased. It existed one moment as a perceived number on a screen in a brokerage account, and the very next moment, simply because nobody was willing to pay that much anymore, it was wiped from existence entirely.
And the real-world devastation here was profound. Companies closed literally overnight. Take Webvan, an online grocery delivery service. They collapsed, wiping out 2,000 jobs in a single day.
Now sure, the venture funds lost their investments, but they had limited liability. They weren't losing their houses. But the retail investors, ordinary people who poured their entire retirement savings into this, were borrowed against their own homes. They were completely ruined. And despite the Federal Reserve desperately stepping in with 11 rate cuts between 2001 and 2003, for those everyday investors, the help just arrived far too late.
Section 3. The Survivors.
But from the ashes of every major crash, something remains. So let's shift our focus to those incredibly rare companies that somehow navigated the wreckage and ultimately built the digital world we all live in today. Look at Amazon. Their stock plummeted to a terrifying low of just $6 in October 2001, falling all the way down from a high of $113. The company was being widely written off by analysts who were boldly predicting it would just run out of cash. But what's truly amazing here is that Jeff Bezos survived this intense, massive pressure by stubbornly refusing to alter his long-term strategy.
And Amazon wasn't alone. An incredible class of survivors emerged from the dust. Amazon obviously grew to become the most valuable retailer in history. Google launched this IPO in 2004, raising $1.67 billion, and amazingly, at the time, many investors actually thought it was too expensive. Think about how profoundly wrong they were. Then you've got titans like eBay, PayPal, Priceline, and Salesforce, a company that launched at the absolute height of the bubble in 1999 and went on to completely redefine enterprise software.
So what separated them? What was the secret? Well, it really boiled down to one crucial difference. The survivors had a genuine, mathematically sound path, even if it was years down the road, to actually making money. The casualties? They only had a compelling, well-told, prestigious narrative. Surviving the crash had absolutely nothing to do with having a better website or flashier technology. It was purely about having an actual functioning business model rather than just a great story backed by fancy venture capitalists.
Section 4. The Minsky Moment.
Now, here's where things get deeply analytical. Let's explore the overarching economic framework that proves this dot-com crash wasn't just some quirky, one-off internet fluke. It was actually a highly predictable, repeatable cycle of human behavior. Enter the economist Hyman Minsky. Decades before the internet even existed, Minsky described this exact mechanism. We now call this the Minsky Moment. Basically, it's the precise point at which a debt-fueled asset boom collapses right under its own weight. Minsky's theory from the 1970s shows us that this cycle repeats with remarkable, almost mechanical consistency across completely different assets and eras in financial history. And this builds out practically into 5 distinct phases of a bubble. Phase 1 is displacement. A new technology, like the internet, genuinely changes reality. Phase 2 is the boom. Capital flows in and early investors make an absolute fortune. Phase 3 is euphoria. This is your pets.com spending $2 million on a Super Bowl ad, where a cool story completely replaces fundamental analysis. Phase 4 is distress. The Microsoft ruling acts as a catalyst, and the smart money quietly heads for the exits. And finally, Phase 5 is panic, that devastating 78% stampede we just talked about. It's wild because the entire history of the dot-com era maps perfectly onto Minsky's mechanical template. Now, let's pull back for a second and look at the macro timeline to trace the really long road to recovery. From the devastating market trough in 2002, the market eventually stabilized by 2004, it recovered a great deal of the losses by 2007, and eventually surpassed its year 2000 peak by 2015. And you know what this proves? It proves something vital. Those early, wildly optimistic hype men were actually right. The internet truly was the most transformative technology in a generation. It really did restructure entire industries and completely remake global commerce.
And this reveals a really crucial distinction between the technology itself and the valuation. The internet wasn't a fraud. It was literally worth everything. The real fraud was the valuation side of the equation, that blind belief that just because a transformation is real and profound, it automatically justifies absolutely any price anyone is willing to pay. Transformative tech is amazing, but it does not justify infinite valuations. The internet was worth everything, sure, but pets.com was worth absolutely nothing because its business mechanics were fundamentally broken.
Which brings us right back to Minsky's haunting logic. The stability itself creates the instability. When times are incredibly good, people naturally feel safer taking on more risk. That increased risk makes the market boom even more, which in turn encourages even more reckless behavior. People inadvertently plant the mechanical seeds for the inevitable bust simply because things are going so exceptionally well. The boom literally contains its own bust, not as an accident, but as a built-in mechanism.
So I want to end this explainer by leaving you with this really profound question to ponder about human nature. Why does the euphoria phase always cost those who arrive last?
The people who lose the absolute most are always the ones who watch their neighbors get rich, panic about missing out on the action, and then jump in at the absolute peak. The tragic irony is that they're almost always right about the future. The internet really was the future, but they are catastrophically wrong about the price. Thank you so much for joining me, and as always, keep questioning the mechanics behind the madness.